Welcome to Echo Trade. It's Jeff Roth. We're here today with Chris Walker from Walker Capital Advisors, and we're here to talk about their portfolio, the WCA Aggressive Growth ETF blend portfolio, available on Echo Trade. So, Chris, appreciate you being here. Thanks for taking a minute.
Yeah, thanks so much, Jeff. Happy to do this.
Yeah, so I want to dive into the portfolio, but first, I'd like to do a quick little background on you. So Chris is actually a true badass, a hero. He is a West Point grad. No joke. U.S. Army captain, awarded the Bronze Star Medal in the Second Iraq War. So first off, you're an awesome guy. We've had conversations. You're awesome just as a guy, but just what you've done for our country. I want to say thanks for your service, Chris.
That's kind. Thank you. Very appreciate it. Very generous.
So freedom's not free. And so guys like you that are out there kind of, making sure it happens for us. So really appreciate that. So professional background, you're a CFA, kind of background in corporate finance, M&A, and private equity, and started Walker Capital Advisors, closing in on 10 years ago, correct?
That's right. Yeah. 10, almost 10, getting there.
Time goes by fast.
It really does. Yeah.
Yeah. Well, let's dive into the portfolio. That's what people want to kind of hear about. So I always like to start kind of just give me a quick background on the portfolio, kind of an overview, and then also include in that, kind of what are the goals and the objectives of the portfolio?
Sure. Yeah. The goal, as is right there in the name, this is an ETF blend portfolio. So this would fit the category passive investment. The construction of the portfolio is a blend of ETFs with a bias toward more aggressive investments. So if you were to sit down with an advisor and try to blend, a number, half a dozen or so ETFs together for a typically appropriate yet aggressive investment posture, this is what you would pick. We have just taken that same blend and shifted, maybe biased toward more aggressive growth, international developing market ETFs. So that's the intent there of the portfolio, is to give people passive exposure with a slightly aggressive lean. Building this on your own, building this maybe more actively, or building a portfolio of small cap or aggressive style investments can be quite expensive. And so one of the things that I hope will stand out for people in terms of access to the portfolio is that the amount of equity needed is quite low. We did that on purpose. We want this to be as accessible to as many people as possible, still get that aggressive lean, but in sort of a one-stop shop.
Yeah. So there's a couple of things you touched on there, in terms of the exposure of the portfolio. So this portfolio isn't invested like only in U.S. stocks. It's really international, and not just, U.S., but also emerging and what's the word I'm looking for?
Developed markets.
In developing markets. Yeah. So what's kind of the importance of that, tying all those three different types of international markets together?
Sure. In general, sort of high level here with the portfolio, about 30% of the holdings are in a small cap ETF, another 20% in mid cap, and then another 30% approximately between emerging and developed markets. And the rest are more total stock market and large cap investments. So you still have that exposure. And again, these are all ETFs, so these are passive investments, but there's an obvious bias towards small, mid, and emerging and international markets. We think that there's some potential there long term for folks. This is appropriate for somebody who's got more than one business cycle to go toward retirement, for example. It is very much a long-term play. And again, we've chosen the ETF route because we want it to be as accessible as possible.
Got it. And kind of putting some focus on the smaller companies in the emerging markets, you're looking to get exposure there in order to have, more aggressive growth, like the name of the portfolio.
That's right. Correct? And look, there's a trade-off there. Everybody knows you take that kind of risk, you can get that kind of reward, but you have to take the risk first, right? So there is a little bit more volatility in the small cap, mid cap, and international markets. But again, long-term investment, more than a business cycle, that return should be paid off. That risk should be paid off in return.
Yeah, exactly. So talk about the risk then. I mean, we talked a little bit about you're adding a little bit of risk, with the types of small cap and emerging market companies you're investing in. But how would you quantify the risk? Is it a high risk portfolio? Is it relative to all equity based portfolios? Is it high risk? Is it medium risk?
Sure.
And how are you managing that risk? Again, it's more long term. I mean, and would you quantify or define volatility a little bit different than risk? Because you're definitely kind of exposing yourself to more volatility, but is there more risk there, and how you guys are actually managing that?
Right. Great question. Right. So because the volatility is certainly high, which I would say that means it's going to be medium to higher risk. We've eliminated some of the risk, the idiosyncratic risk for sure, by going the ETF route. So what we're more exposed to is small caps as a category by going the ETF route, rather than trying to pick and choose a few stocks there. With the international investments, it's quite similar. Slightly different risk though, in that when you go to different countries, not all of the regulations are aligned with how we manage equity investments here in the U.S. So there are different standards that apply. The most common one that people refer to is U.S. GAAP versus IFRS, which is it's a different accounting system. All of those risks are accounted for and to some degree mitigated by investing in the passive vehicle rather than again going after individual companies.
Yeah, gotcha. And like you said, you have to withstand kind of that volatility, and so you mentioned that this is more appropriate for going through at least one full market cycle. And so, can you define that and kind of what that time horizon looks like and the reasoning for that?
Yeah, in my opinion, this is more appropriate if your investment horizon is somewhere between 15 and 20 years. That 20 years would be 2 full business cycles. Yeah. Right. So you get the benefit, sort of the up and down there, of exposure to a more volatile but ultimately higher return paying market, particularly small caps. I think the evidence is pretty clear that over a long horizon like that, the return on small caps tends to be higher. You think about why that is. I just had this conversation with somebody yesterday. Netflix in 2010 was a small cap stock. I mean, think about where that is today. Yeah, that's part of what pulls the performance of small caps higher. There's just so much room for exponential growth. Not every company is Netflix. They're an obvious outlier. But in investing in a passive vehicle, you're getting exposure to companies like Netflix 10, 15 years ago. Yeah.
Exactly. And so can you talk a little bit more about, your investment process, kind of what are you looking for when you're kind of, choosing the different ETFs? And again, talk about, that you are investing only in ETFs. You're not investing in individual names, right?
Yeah, that's right. In terms of process, look, we are looking obviously at net return. So we're of course accounting for expense ratio here when we evaluate what an investor can expect in return. We are looking for reputable names though. So all of the vehicles that we've chosen are Vanguard funds. We feel pretty strongly that Vanguard that their reputation is somewhat they're ubiquitous, right? It's obvious. So we don't have any issue with the management, obviously, of those funds. That's again a solid name that everybody recognizes. We know the performance is going to be great. We know they're going to minimize the expense ratio as much as possible. So in terms of process, the only things that we look for are any sort of deviation. If there's a change in management, we might have to think about changing funds. But so far since we began following the process, which is now 2.5 years, the process has been yielding some great results for our clients.
Got it. And so, are you looking more just on the fund side, or is there any kind of sector or industry that you're looking at when you're deciding on what ETFs to
great? Yeah, it's a great question. Purely the fund side. We're not looking at an individual sector particularly. This is about funds. This is as much high level, sort of top down as you can get with the analysis. We're just trying to get the right blend of exposure to different markets to set people up for success long term.
Got it. So, I guess to cap it off, we've done a good job of kind of explaining everything, but if you want to just wrap it all up in terms of kind of what makes us different from other portfolios that are available, kind of in the broader market, of other asset managers, and why somebody might want to invest into this portfolio.
Yeah. The reason that this portfolio has been attractive to our investors so far, the returns have been really, really strong, and there is no active management involved here. So this is purely passive. It's a one-stop shop with, again, a very low barrier to entry. That's intentional to make this as accessible to as many people as possible. And what they get is a little bit more aggression for sure, but certainly if this is, for example, in an IRA over a long period of time, I think the return on these, the data tells us, will be better than a typical target date retirement fund.
Yeah.
So if you're not particularly financially savvy, you can come to one place the same way you can go to a target date retirement fund, one place, and end up with a better return over a, again, 15 to 20 year horizon.
Perfect. All right. Well, Chris, I appreciate you taking the time. Investors can kind of learn more, and they can subscribe to the portfolio WCA Aggressive Growth ETF blend within Echo Trade. Thanks, Chris.
Thanks, Jeff. Take care.